Hi, I'm Chloe Carruthers here with Barry Norris, the fund manager of the Argonaut Absolute Return Fund, here for our monthly update. Barry, August saw a reversal of the summer rally in risk assets. What caused this?
Well, Chloe, near the end of the month at the annual symposium for central bankers at Jackson Hole, Fed Chairman Jerome Powell pushed back against any notions that there'll be a Fed pivot to the dovish side anytime soon. He said two things. One is that interest rates would have to go up and stay up in order to defeat inflation. And secondly, that defeating inflation would involve some economic pain. And that, of course, means unemployment. And I think this really pushed back anybody's ideas that we were going to have a soft landing and we were going to be back to a bull market anytime soon. So as a result of that, Fed fund futures went from pricing a peaking interest rate of 3.25% in December of this year to 4% in March next year. So if you think that bond and equity markets are currently still largely priced for this soft landing where corporate profitability stays high, but interest rates come down, that scenario, as we predicted last month, is frankly for the birds. And Chairman Powell seems to agree with us. And as a result, he's closed the window for risk. So central bankers are now suppressing animal spirits of the market. And indeed, a couple of Fed members said that they were delighted that the stock market fell as a result of Powell's speech at Jackson Hole. So this will entail probably a continuation of the bear market in financial assets, and probably that the market tests new lows later this year. I think we should, however, caveat all this tough talk on inflation by saying that it's easier for Powell to talk tough when there frankly isn't yet much pain apart from inflation in the real economy. So should unemployment rise, and when unemployment rises, there's going to be a lot more political pressure on the Fed to tone it down and turn dovish. And amazingly, given 9% current inflation in the US and full employment, some members of the FOMC committee, according to the minutes released in August, were actually concerned about the effects of hiking rates too fast, too soon. So we're not totally convinced about the Fed's hawkish rhetoric and Powell being the second embodiment of Paul Volcker. And we'll see next year when the going gets tougher, how much this translates into the Fed sticking with its hawkish stance.
Markets ended up having another poor month in August, but the fund delivered an uncorrelated positive return. Why was this?
Well, the fund made money in its short book, and I think we should probably expect that when the market return is negative. And our best performing short was the beleaguered movie theatre chain Cineworld, which fell 85%, which we talked about in our recent interview on Bloomberg TV, which is on our YouTube channel. But the fund actually also made money in its long book, even though the market fell during the month. And the best performers were in energy shipping. Our biggest holding, oil tanker company Euronav, was actually our best performer, rising 25%. And that was as a result of further anticipated disruptions to the global trade patterns in crude oil exports. And it's worth also saying that refined oil tanker company Hafnia, which was up 31%, also performed particularly well. So it's important, I think, to remember that we have this situation where although, for example, the UK has stopped importing oil products from Russia, most of the rest of the EU are still importing exactly what they were importing before the Ukraine war. That might come as a surprise to many because obviously the EU have announced sanctions on Russian oil exports. But in fact, the ban on crude doesn't come into effect until December, and the ban on refined products until February. So if the EU go through with this ban, and I think there's some evidence that they're trying to wriggle out of it, and it was a ban that they hope never to introduce, then that would involve much bigger upside in these oil tanker and oil product tanker stocks as we go into the winter.
The pound fell to new lows against the US dollar over the month. How does the fund manage foreign exchange risk?
Yeah, so the pound has now fallen 15% or so against the dollar year to date to its lowest level since COVID. And it's fair to say that the British economy is in its worst state since the 1970s. And slowly but surely, the legacy of Britain in the 80s under Thatcher, where it was a oil exporting, lower tax, small government, higher productivity economic miracle, has been lost. And we're not exactly the sick man of Europe nowadays, but that's only because Europe has its own challenges. So the fund hedges its FX risk, which if you're in the sterling share class, it means that you don't benefit from sterling weakness. But we also offer a US dollar share class and indeed a euro share class for masochists for those who want to hold their assets in US dollars. And indeed, we're about to reopen a Swiss franc share class as well.
European power prices hit the equivalent of $1,000 barrel of oil during the month. Why was this?
Yes, that was an amazing statistic, wasn't it? That power prices hit the equivalent of $1,000 a barrel, and gas prices $250 a barrel at a time when oil was $95 a barrel. And you to think that normally oil commands a massive premium to other energy sources simply because it's a higher, more quality, more sophisticated fuel that can be used for so many different things. But oil, of course, isn't widely used for electricity markets. Although Sweden, for example, still has some oil-fired power plants, which it's now switching back on. But the price of any commodity is determined by marginal producer costs. So let's say for oil, there are two producers. Let's, for the sake of argument, say Saudi Arabia produces oil at $20 a barrel and the UK $100 a barrel. Now, Saudi Arabia would never sell that oil for $20 a barrel when it knows that there are other people that have to sell for above $100. So Saudi Arabia would take $100 and make $80 a barrel. And that is why, even though the gas is typically only 40 to 50% of most national grid generation, that is why gas as the marginal swing factor sets the power price. And I think there's an additional important factor in the power markets in that natural gas is the main source of reliable energy. And I mean by reliable, our ability to switch it on when the wind isn't blowing and to switch it off when the wind is blowing. And that's why no matter how much wind power you have and how apparently cheap wind power is, it will always be natural gas that sets the power price. So a message to government is that you will not get power prices down by just investing in renewables, because as long as renewables are intermittent, and that means that there is no mashed industrial storage, which frankly, as we've outlined previously, is exceedingly unlikely in the short term, the gas price will always set the power price. So message to governments, you need to invest in gas powered electricity, and you also need to make sure you're sourcing your gas from reliable countries. So I think, look, power prices have halved this week from that $1,000 barrel of oil equivalent peak in Europe. But if you think that the long-term price is about $45 or $50, this is not a level in which European industry can operate, and this is intrinsically linked to cost of living, obviously, because if you think about standards of living before we had fossil fuels and standards of living today, frankly, if we don't have fossil fuels, we go back to pre-industrial levels of standard of living. And that, I think, is something that we all need to bear in mind.
The G7 just announced a price cap on Russian oil, and the EU has announced it would intervene in its power markets to bring down prices. What do you make of these proposals?
Frankly, Chloe, not much. So on the Russian oil price cap proposal, the G7, all of whom are supposed to be boycotting Russian oil by December anyway, has said that they'll impose a price cap on Russian oil where other countries shouldn't pay more than that price for any Russian oil that they're importing, that they're currently buying for a discount anyway. So obviously the logic of that is pretty dumb. Russia has said it won't sell any oil to any country participating in the price cap. And there are those who naively think that Russia is so desperate for revenue that it'll be forced to go along with this. But as we've seen with gas, Russia is quite prepared to export lower volumes for higher prices, knowing that Russia has the energy leverage, not the West. And it's worth pointing out, I think, that currently 17% of global supply of oil, which is incredibly tight, is currently subject to sanctions. So if you add up Russia, Iran, and Venezuela, that's 17% of current global production. And then, of course, you have their OPEC friends on top of that, who are not going to be happy that there's a buyer's cartel as well as a seller's cartel. So I think no one who knows anything about the oil markets thinks that this Russian oil price cap has any chance of working. And at the moment, of course, we have a power crisis, which is caused by two things. One is these crazy net zero targets, and the other thing is our reliance on Russian gas. But actually, oil is still pretty cheap at under $100 a barrel. So this, as a result of this proposal, we could actually have an oil crisis as well as a power and a gas crisis over the winter. I think on the EU power market intervention, this is again another example of the EU thinking it's got the power to intervene in markets to set prices when it clearly doesn't have the ability to do this. So there's no way that any gas exporter to the US is just going to decide to sell to the EU because they've announced a price cap. If you remember all of that LNG that the EU is importing, they're competing against Asian buyers to import it, and simply those LNG cargoes are going to go to Asia rather than Europe if Europe throws its toys out of the pram. Therefore, the most likely scenario is that the power utilities of Europe become the patsies in all of this. And if you remember last year, the French government decided that EDF, the French nuclear power operator, was not going to benefit from this investment in nuclear power that its shareholders had done, and in fact was going to subsidize not only its customers' bills, but the bills of its competitors as well. And as a result of that, the EDF share price completely crashed, and the French government has largely expropriated the assets itself. So I think that the way that this EU intervention seems to be going is that the EU will take any profit from European power utilities and use that to subsidise bills over the winter. And they may see that as a good short-term fix and amelioration of the crisis, but it will make European power utilities, frankly, even more uninvestable than they are now and exacerbate the crisis. Because as an equity investor, if there's no upside in the good times, then frankly, why bother investing in a company that is only allowed to have bad times? It's completely asymmetrical, and of course will lead to massively higher cost of capital and just an absence of investing in the future, and a bigger problem for the long term. So I think, Chloe, both of these interventions by the EU are yet another example of the EU bureaucrats exaggerating their power and their ability to intervene in markets.
Great. Thanks very much for your time, Barry.
Thanks, Chloe.